Hello, and welcome back to the Wallfacer podcast. Today's guest is Dion Chu, co-founder and CEO of Term Finance, a fixed-rate lending protocol. Term has raised just over $7 million from investors like Electric Capital, and their token just went live a month ago on leading exchanges like Kraken. Dion, welcome to the show.
Brian, thanks for having me. We're excited to be here.
My pleasure. So, for any listeners who might not be familiar, can you tell us about Term Finance and what makes it unique in the lending space?
Yeah, I think, at its core term is relatively simple to people who are familiar with DeFi lending. It's an over-collateralized lending protocol, just like Aave, on EVM chains, primarily ETH mainnet. The key difference being that instead of floating rate or variable rate loans, on term, everything is done at a fixed rate for a fixed period of time. And the primary way that these loans are matched is through a weekly auction process.
Interesting. So, just thinking about the landscape of kind of lending today, the auction mechanism feels kind of unique and fixed rate, of course, has been tried several times in the past. And, obviously variable rate still kind of dominates the space today. What was the maybe insight that you guys had that made you feel confident that this was kind of a path to go down? And what sort of success have you seen so far?
Yeah, I think to answer that question, the first question is what makes fixed rates more difficult? The benefit of the variable rate lending protocols is that one, they're open-ended loans. So you can borrow and repay whatever you want. So you can lend for as short or as long as you like. And there's kind of standing liquidity. All of these loans are essentially fungible or interchangeable. With fixed rate loans, it's not the case. Each loan has to have a specific maturity date, and each loan has a different interest rate. And you also have to coordinate both sides. They have to be both on the same page. There must be a meeting of the minds, so to speak, between the borrower and lender in terms of how long the loan will be for and at what interest rate they're willing to do that. So that's the difficulty. On top of that, when the loan matures, borrowers have to repay actively, and lenders have to redeem and reinvest their loans. So it's a little bit more administrative work than just dropping your money in a black box and walking away. So that's the challenge. But of course, as we know, in TradFi, fixed rate loans are the default of what you think of when you think about taking a loan. So there is a lot of demand for it. So how do we solve this? And what were the problems with the protocols that have tried this in the past? The earlier version of fixed rate lending, so the Think Yield protocol or notional finance, they tried to mimic, traditional DeFi liquidity pools. So they set up AMMs. On one side, you had stable coins. On the other side, you had fixed rate loans. As we know with AMMs, they are specific to a pair. So what this meant is that every single loan with a different maturity date required its own separate liquidity pool. So right off the bat, you have liquidity fragmentation. The second problem we know from AMMs is that they're extremely capital inefficient. So you need 50% of the pool sitting in idle cash that's generating zero yield to offset fixed rate loans that you have on the other side. What that meant in practice was that absent liquidity or token emissions, LPs were earning only about 2.5% annualized return. So it wasn't a sustainable model for LPs to really park all this idle capital in. Especially in a model with fixed rates. Fixed rates aren't meme coins. They don't trade, multiple times turnover a day. So the transaction volumes were low, the fees were minimal or de minimis, and you had a lot of idle liquidity. It was just not a capital efficient structure. And I think the third challenge, to understand that, you have to look into the lending markets. If you look at Aave, top 100 borrowers account for something like 85% of TVL. So it's heavily concentrated towards whales and institutions. That makes sense if you think about it. Your average retail user, they're trying to make 10, 100x trading a meme coin. They're not trying to earn 5 to 8% on stablecoins. This is not what they're looking to do. It is more geared towards large users. And so the third problem with these AMMs was that the whales needed to transact at sizes of $1 million plus per transaction. And because of the way these pricing curves worked, couldn't really borrow more than a couple 100,000 at a time before you saw your interest rate go from like 4 to 6 or 7%. So it just wasn't scalable to the needs of the users who actually use on-chain lending. So those are the problems and challenges. And the way that we solve that is say, okay, forget about on-demand liquidity That's just, at least in stage one, not going to be feasible for fixed rates. In a prior life, I was a government bond trader. The way the US government issues bonds for bills is through a weekly auction process. Every G7 country issues government bonds through a weekly auction process. It's typically done as a sealed bid, single price auction, meaning that you don't know what other people are willing to lend at. Clears, everybody gets the same price, so it's fair to everyone. So that's what we decided to do. Let's bring this sealed bid, single price auction into DeFi, build it on chain in a DeFi native way to match borrowers and lenders directly. So yeah, that's kind of the basis of, how we ended up falling into the auction model. And so far it's been successful, with our institutional user base, doing a transaction once a week has not been a blocker.
That's great to hear. On the way that the treasury and other G7 countries do their auctions, I'll be honest, I've just kind of been learning about this recently as it's in the news quite often. Just, Besant's role of going out there and selling bonds, basically. I'm curious how much of those mechanisms you were able to sort of just one-to-one port over versus aspects that you sort of had to redesign for the constraints or benefits that on-chain can bring to some of those auctions.
So the first complication is with the government bond auction, it's really a one-sided market. The government says, this is how much I'm selling. And then the lenders come and they all put in different prices for where they're willing to lend. With term, it's a two-sided market. So you have an unknown amount of borrowers, an unknown amount of lenders. And so it has a little bit of complexity, but really not too much. And so that's the first thing. We had to create a two-sided auction, is what they call it in the literature. So that was one change. But a lot of the other things we borrowed straight from treasury. So, for example, you have the case where, let's say the marginal lender, there are two people on the marginal as a marginal lender, and total they have 10 million supply, but there's only additional 5 million in demand at that marginal yield. How do you split the pie? So the way the treasury does it is they say, we're going to do a pro rata on the margin. That means it's going to be proportional to the amount that they offer to lend at that same rate, and you allocate accordingly. So that we borrow directly from TradFi and poured it into DeFi. In terms of the technical side, blockchain really enables a lot of improvements in terms of settlement. So when we clear an auction, everything from gathering the prices, calculating the clearing rate, and settling loans to the users happens entirely in a single block on the blockchain. So there is no middle office in the back shuffling funds around, far more efficient than what you have in TradFi with clearing, DTCC, moving cash back and forth. It's just a much more seamless process. The biggest challenge I would say is, how do you create a blind auction on chain, right? Everything on chain is public and, it's designed so that you're not able to hide things. So then how do you create an auction where it's truly blind? So that took a little bit of challenge, but ultimately we landed on a commit reveal process where when you submit your bid in the first instance, generate a random number, you hash the combination, and what you see on chain is this hash that is, cryptographically not possible to decode. And then when the auction closes, the user then goes back to reveal the true number. Obviously, not everybody has the time to do that. So the protocol also offers a service to reveal that number on behalf of the users. And that's what most users offer.
Yeah, I'm curious actually within both your markets and then the broader treasury markets. Do you see any collusion between folks to either try and get a better rate or lower the rate for some reason? Do you see that? Is that a studied phenomenon at all?
So actually, in terms of an auction as a market mechanism, the literature says it's actually the most efficient to getting towards a efficient market clearing. And it surrounds like the game theory about an auction. So the idea is, and generally what they call it is incentive compatible. So in order to have an incentive compatible auction, what you need is to ensure that the mechanism is such that your bid does not impact the clearing rate. So if your marginal rate can influence the clearing rate, then you'll be incentivized to alter your behavior. But if you can design the mechanism such that whatever you put in has no impact on the final outcome, then there's never any incentive for you to shade your bid or try to report anything other than a true value. The way you do that typically in the context of auctions is say the clearing rate is actually going to be the average of the second best bid and the second best offer. And in that way, it makes it, with enough users, impossible for you to individually or unilaterally change the outcome of an auction. And when that is the case, then there's no reason for you to report anything other than your true bottom line. You'll never do any worse than the rate you submit. And in most cases, you'll end up doing that.
Got it. So coming back around to some of the market dynamics that you've seen in the supply and demand side of the market, I believe I caught you in another interview saying that the borrow demand has kind of consistently outstripped what you've seen on the supply side. I guess one, is that correct and still the case? And if that is so, what sort of dynamics do you think have led to that?
Yeah, I think, when you think about traditional markets, it's much more balanced. On the one hand, the capital, the asset holders are typically large institutions like pension funds, large banks. They have much lower cost of capital and they're much more risk averse. On the borrower side, you have hedge funds, businesses who have a higher cost of capital and their job is to manage risk. So you bring those two parties together and you have a natural fit. Problem with DeFi is that you don't have pension funds, you don't have 401ks, you don't have banks. So everyone in DeFi is, risk seeking and has very high cost of capital. Imagine if you tell your mom, I'm raising a hedge fund to invest in crypto, or your uncle or aunt. If you're not giving them 20%, they're not going to do it because it's just, for them, represents an extreme amount of risk to be playing in this market. What you end up happening is you do not have a very diverse, user base within crypto, and it becomes very PvP. So I think that's a challenge. But over time, as institutions do come into DeFi, you start to get a diversification where you have different risk preferences, and across those risk preferences, you'll be able to create a larger market between the low risk lenders and the higher risk seeking borrowers.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
What specific approaches, if any, are you doing to try and either cultivate some of that capital or, of course, I don't expect pension funds to be on chain today, but, what are then other maybe alternative sources that you're going out and seeking on that lender side of the equation?
Yeah, so earlier on I was speaking in general, but obviously it's a oversimplification. If you look on Aave, there seems to be infinite supply of billions of supply of stable coins earning 2%. That just never moves.
This is something that regularly baffles me as well, by the way.
Exactly. And then you have similarly a ton of ETH that sits there or less than the staking yield. So these people do exist on chain. And so really it's first and foremost, how do I find those people? How do we develop and explore those relationships? And over time, you start to get some names and you start to figure out who those players are and try to build relationships. That's a low-hanging fruit, the people who are already on chain and are risk averse and willing to accept lower rates of return. I think what's interesting in this new administration is that a lot of the traditional finance institutions are starting to get more crypto curious. So we've been talking to these institutions for a long time. Speaking last year, the conversation is, well, DeFi is very risky. I'm worried about sanctions. I'm worried about securities risk. I just can't touch it. And you have the conversations now, in the last couple of months. The tone has completely changed. They're saying we're actively researching DeFi. We're interested in DeFi. It's something we want to do in the next 6 to 12 months. So, the tone has certainly changed, but it will take some time. These are slow moving institutions and, they're not going to jump in quickly.
Right. And I always think the risk with these institutions is that by the time that they finally are prepared to start doing things on chain, something happens where they're, the FTX moment or whatever it is, their compliance department says, all right, let's kick this out another 2 years, and cycle kind of repeats. I really am hoping that that is not the case this time.
Us too, absolutely.
Yeah, definitely. So we talked about just now how, Aave rates are at a recent all-time low. I mean, Aave rates, Spark has brought down their Sky savings rate, I think 4 or 5 times within 2025. Compound rates are very low. Real APYs on Amorpho, et cetera, very low. All of the variable rates are quite low. Have you seen, just based on the nature of your auctions, have you seen maybe higher rates across the board? Or, are you just sort of in that same trend where your rates are coming?
Yeah, definitely it's a competitive market. So if you don't have competitive rates, users are going to migrate elsewhere where they can get lower rates. So I would say in general, rates on term do track the broader market. I think the key benefit though really comes down to kind of some of the drawbacks of the variable rate lending. So we spoke earlier about its benefits. It's easy, you deposit, you walk away, open-ended loans, you can repay whenever you want. But what are some of its drawbacks? One of its biggest drawbacks is that it's a model that requires there to be idle liquidity in the pool. If it's not idle, there's no way for users to withdraw their funds. And it works kind of like a fractional banking system, right? Typically, they likes to see at least 10% idle capital so that, normal withdrawals will go through without any problem. If 100% of the supply is borrowed out, then there's nothing to withdraw and you're kind of locked into your loan with no definite end in sight. So that's a problem. And the way that Aave addresses that, or all variable rate lending protocols address that, is they start to charge very punitive rates when utilization gets too high, which is what causes these spikes upwards of 60% when that happens. But there's a cost to this idle liquidity. The idle liquidity means that that liquidity is diluting your yield as a lender. That means at, generally around 10, currently maybe like 30% of your yield is being diluted away because there's so much idle liquidity sitting around unused. So that's the first problem. And on top of that, obviously our Aave charges this additional 10% spread on top of that. With term and the direct matching model, we don't hold on to any idle liquidity. So in this auction, you either get a loan or you don't. And what that means is because there's no idle liquidity, you don't have the spreads that you see in Aave. So even if term clears at market clearing rates that are on par with Aave, lenders are getting significantly more than what they would be earning if they just simply deployed their idle liquidity on Aave.
Yep. Makes complete sense. At a protocol that I used to work on, we had a similar kind of thing where one of the things we tried to implement, and we did implement, was what we called liquid exit, or basically an exit penalty. If you tried to leave the pool as a lender and utilization was over some threshold, lenders ultimately hated it. But I actually think it did work kind of well at sort of incentivizing when rates were when utilization was very high. We didn't want people to leave. When utilization got low, we were sort of indifferent. But yeah, I think there's a lot of ways people try to go about that, and obviously with just direct matching, it works great.
Yeah, that's our thesis.
Yes. So actually, just getting into that a little bit more, I know that you guys have a few products today. I might mess them up a bit, but there are the blue sheets, which are a little bit more of kind of a simple earn product. There are the meta vaults, and then obviously the direct matching as well. Can you kind of talk through how all of those interact with each other? And then actually, I'd be curious of the kind of order of when they went live as well, and just how that matches up with the thinking of how the protocol has kind of evolved over time too, and maybe how you think about attracting these different types of capital.
Yeah, so I think the way that we think about it is there's 3 tiers. So for the advanced power users, the core auction model is the best fit. It gives you full control over exactly what you're lending, the amount you're lending, the term over which you're lending, and the rates that you're going to pay. But it is a little bit more burdensome operational. You have to, typically, the users there are larger institutions with dedicated DeFi trading desks, where their day job is to do this kind of work. For them, once a week is not a heavy lift at all, and they're able to come in and participate and monitor these auctions. I call the core auction model for the advanced users, the power users. I think the second intermediate tier, that's the blue sheets. So what happens when there's an auction? Any lender who is successful receives an ERC20 receipt token. We call that a repo token. And that represents your claim to principal plus interest at maturity. You would burn that token and receive your USDC back. This token is a standard ERC20. It can be transferred. So what Blue Sheets is kind of a simple listing contract. You can think of a simple order book where somebody who made a loan in an auction can turn around and sell it through this listing contract. Kind of abstract away, all of the capital efficiency issues with AMMs. It's just these tokens can be bought at a fixed rate. That's it. Price never changes. You buy as much as is available, and then it's gone. So that keeps everything simple and capital efficient. That's for the intermediate user. Now you no longer have to monitor these auctions. Maybe Wednesdays at noon is not convenient for you. You have a weekly call with your boss. Now you can come on the weekend and make a loan at the same rate, roughly the same rate as the auction, at your own convenience. So that was very popular when we watched it. But with that, there's still some additional complexity. You still have to remember to redeem your loan at maturity. And then at maturity, you have to make a decision of what you're going to now, where you're going to allocate your capital next. So there is still some operational burden to managing your own fixed rate portfolio, even if you've abstracted away the auction process. That's where the vaults came in. The vaults, I'd say, is for kind of the most passive user. And it's not reserved for retail. We have family office users who say, look, we don't have a dedicated DeFi team. We like what you're doing. We just want to make it easy. So these vaults, this is much more familiar to your standard DeFi protocol. You deposit your tokens, and that's it. You have curators who will manage the weekly operations around the auctions. And the vault itself automates all of the redemption and reinvestment that happens in the portfolio. And within these vaults, any idle liquidity that's not being deployed in a term will automatically fall back into something like Aave. So it's not idle. You still earn some yield on unutilized capital.
Yeah, that's great. So basically, at every stage of the protocol, you're trying to avoid unutilized capital for lenders and LPs. Nice. Well, coming back a bit to the borrower side of the equation too, I'm curious if you guys have any differences in the collateral base or makeup from your borrowers than what you see at other major protocols, or just kind of what the collateral makes up of what people want to borrow against.
Yeah. I think the first thing to note is that everything on term of collateral are segregated. So more like a Morpho model than an Aave. The collateral backing any specific loan is segregated from everything else. Even if it's the same collateral, but a different maturity, those collateral are also separate. And that's important because that prevents any, risk of contagion of bad debt and one loan crossing into another. So that's one thing I would keep in mind when looking at term. In terms of the collateral mix, obviously you have your traditional Bitcoin, wrap stake, ETH collateral, all the majors that you see on protocols like Aave and Compound. But because it's isolated, we're also able to onboard more exotic collateral like those you would find on Morpho. So it's quite popular to borrow against PTs. Backing a term is the only protocol where you can hold a P, lock in a fixed rate on a PT token, and lock in a fixed borrow through term for the exact same period of time to maturity, and really lock in that spread between the two. So that's a very popular trade of term. Yeah, what you'll see is as far as exotic collateral goes, these largely driven by our users and tends to follow whatever the most popular new pre-token project is currently live in the market.
Yes, I definitely noticed that as well as kind of an overall trend of borrowing activity. So coming back around to some of the cross-chain stuff that you guys have done, obviously, I believe you started on ETH mainnet. Today you're on Avalanche. And are you on any other chains as well, or just Avalanche and mainnet?
It's Avalanche right now. We're
Great.
in the process of beginning a deployment on Base. So that will be kind of the next destination. And then, and talk with other chains to start branching out elsewhere as well.
Right. Well, what I was really curious about is, have you seen any different market dynamics of your users on Avalanche versus what you've seen on mainnet? Besides, obviously, maybe different collateral types, but I'm curious if there's any other differences you've seen there.
Yeah, absolutely. I think that market still largely lives on Ethereum. When you talk to these whales, especially whales that have hundreds of millions on chain, they still feel much more comfortable with Ethereum. Gas fees on Ethereum are quite low right now, and even when they were higher, given the volumes that these institutions were securing, really wasn't meaningful from a percentage perspective. So the benefit of lower gas fees was not something that was that meaningful for the large institutions. whereas the risk of having centralized sequencers was something that was concerning. So overall, I think all the wells still primarily stay on Ethereum L1 as a home base. They venture out into L2s occasionally to earn additional yield from whatever incentives new L2s might be offering. But for the most part, they ultimately migrate everything back home to L1, where they feel the most safe. You mentioned collateral. Collateral is a major driver. Right? Most of the borrowing these days, or a lot of the borrowing these days outside of Bitcoin and ETH against Bitcoin and ETH collateral, is for these new farming tokens. And so if you're on a chain where there's no yield opportunities, there's no demand to borrow as well. So that's also a big driver of where these borrowers tend to flock.
Yeah, this was actually an observation that I feel like I should have known. You talked about it, but just a few weeks ago, I was looking through our site, vaults.fyi, and was surprised to see that very consistently, from a lender perspective, the highest yields are still consistently on mainnet. And I think it kind of hits on everything that you've just alluded to, which is that still the majority of borrowing activity happens there. And by extension, the better yields remain there. But yeah, I mean, it's a difficult thing that if I was working in L2 or alternative L1, I would be a real challenge, which is just how do you attract more borrowing demand to your chain and by extension, better real yields?
Yeah, it really comes down to where the yields. If there's yield, there will be borrow demand and there will be lending activity. So it's all driven, I think, ultimately by the asset issuers. When Athena was on the Ethereum L1, they're offering double-digit yields, and so all the borrowing was on one. As they move cross-chain, that brings some of that yield to another chain, and that drives activity. But yeah, I think it all originates from where is this yield coming from in the collateral side? Where does it live?
Right. So we've talked about institutional capital a few times here. I think in one of your most recent responses, you just mentioned that you guys do work with and talk to some kind of family offices. I guess they have many considerations, I suppose, when they're thinking about getting active on chain. We've alluded to and talked about some of it here, but I guess what are some of the strongest selling points you've been able to make to them? Is there an aspect of which they're able to more easily understand how they're generating the yield with term versus other places? Are they very glad about the fixed nature as it's more what they're accustomed to? Like, where have you seen success in those pitches?
Yeah, I think once you get on a call with an institution, the value proposition is pretty straightforward. And I've already touched on it before. But typically when you're in a bull market and Aave rates start spiking upwards of 60% multiple times a day, it's very easy to find borrowers. You say, hey, look, you know what you're going to pay in the next 30 days? No idea. Come to term, we'll lock it in for you. You'll know exactly what rate you're going to pay, and you don't have to stay up at night worrying about whether or not your spreadsheet is now in the negative. That's a very easy sell to the borrowers. And on the lending side, we kind of touched on the yield dilution due to the requirement for idle liquidity on Aave. So with term, we can allow borrowers to borrow at a rate lower than what's printing on Aave and still offer lenders a higher rate because the spread is usually so wide. On average, I think 2 to 3% wide between the supply rate and the borrow rate on Aave. So you can very simply kind of slide in the middle somewhere, and both borrowers and lenders are getting a better deal than what they would get on Aave and have the certainty of fixed rates.
Yeah, I think when you put it like that, the sell does sound pretty easy. So coming back to some of the fixed rate nature and architecture, I'm curious if there are any security benefits there as well. You've already mentioned that you do have segregated collateral, which I think is an obvious piece there, but I'm just wondering if some of the auction nature, if there's things that make you perhaps, I don't want to offend other protocols, but more structurally sound, perhaps from a security and auditability perspective.
Sure. Yeah, I think one major thing, you look at other lending protocols, its benefit is that it's open-ended. You can come in anytime, flash loans, swap in and out. The atomic transactions is a key benefit, but it's also a key attack vector. We've seen lending protocols in the past get exploited because of the ability to open and close loans within a single block. With term, the only way to open a loan is through an auction. In the auction itself, there's a gap of time that must pass between the time the last bid is submitted and the time the auction actually clears. So that clearing process is not atomic in the sense that there is a time gap between. So that closes off all of those flash loan attack vectors where most of these lending protocols in the past have suffered from. So, it's pros and cons. You can't do automated looping this way, which is a con, but from a securities perspective, you close off that flash loan attack vector.
Yeah, well, I guess you can't do automated looping, but have you seen other just general looping strategies that people are using your LP shares for that have kind of increased overall demand for the lenders and borrowers within term?
Yeah, absolutely. Most of the institutions, they don't put all their eggs in one basket. So if they want to do a leverage trade on Athena, for example, it's not possible for them to put 100% of their assets and then 10 times lever that into one single asset. So for them, it's quite easy for them to say, okay, I'm going to borrow 10 million from this other pocket, buy 10 million of Athena, borrow 8 million out, and then repay that other pocket. So essentially they did a full loop, with a bridge loan from themselves, just kind of shuffling capital from one pocket to the other, and they're able to get on the full loop. But I think where the difficulty lies is for kind of maybe smaller accounts where you don't have a lot of money to move around and temporarily bridge loan. They want to get a full 10x leverage or they want to take a lot of risk and they're not worried about being 100% in a single trade. They just want to maximize yield. And I think that's where it gets more difficult. But yeah, I think from the institutional side, for sure. They use this looping just by doing a bridge loan to themselves, borrowing from the auction and repaying it.
Interesting. I'm going to have to re-listen to that and think about that again afterwards, but it sounds like an interesting move. Well, something else that maybe is a little bit more current going on kind of within term is you guys just launched your token about a month ago. Tons of different questions I could ask about that, but maybe the most relevant one to some of our listeners who are other people in DeFi or founders would be, what do you wish you had known before launching your token that you know today that you would kind of suggest other people to think about or take action on prior to a launch?
Yeah, that's a great question. I think you hear about airdrop farmers, you don't really quite understand the extent to which it is a problem, especially the civils that are in the space. And so I think one thing is like don't underestimate. You do everything you can to try to filter out the civils, try to find the real users. And even then, a huge swath of them are still just mercenary, um, mercenary users, not real users. And so I just think that is a problem in DeFi in general. I think the way we got here was for 2017, everybody did ICOs. People would buy into the project and they would hold because they're invested. And the SEC said that's a security, you can't do ICOs anymore. So a couple prominent projects said, okay, fine, if we can't sell the tokens, we'll just give them away to people who weren't expecting anything. We were just actually using the protocol and it became kind of a retroactive reward for people who helped build the protocol. Then everybody started copying that, saying, okay, airdrop. And then people just said, oh, well, I can get money for doing random things. So it became an expectation. And once it became an expectation rather than a surprise, that created like perverse incentives where people would come in, kind of farm a protocol, get the free token, dump it immediately, cash out, and then move on to the next one. And so that model, I think, is slowly starting to break down because it's not sustainable. Everybody's only there for the token. It became a model where originally it was rewarding users who are actually interested in the product. And then now the token itself is the product. And, so I think that's something that has been a problem. And there's a ton of that going around. You see it, in our community, and these people get really mad. There's always mad people. Like, well, you give me free money, but you didn't give me enough free money. It's gotten very toxic, I think.
Yeah, I mean, the way that I tend to think about this is, the Uniswap airdrop, which I guess is kind of the one that really pioneered this, was a lot of users with no expectation of anything. And so they were
Yeah.
very happy to receive something. Now, every user has a very high expectation of what they will receive. And so, with rare exceptions, people are always disappointed. And so, it kind of feels like this battle that the expectation is you have to give this airdrop, but you're not going to please anybody at the same time. And I think you kind of said this, but I'll restate it, which is like all these things have sort of a diminishing return of like the people who are receiving the thing. So I don't know if there's a future past kind of airdrops, but I'll be happy to have that person on the podcast if they kind of figure it out.
Yeah, exactly. So we'll see. I think season 2 we'll try doing it a little bit differently. I think we'll be
Oh,
focusing more
I was
on.
gonna,
Sorry.
oh, please, sorry. No, sorry, you go.
Oh yeah. I think for season 2, we're going to probably do a lock drop, a pretty long lock. We do want to still reward our users, people who help build a protocol. There's something cool about that. That's very Web3. But at the same time, we want to discourage people who are purely here just for the token, for that free token. But I think with a lock drop, with a pretty long vesting period, would discourage kind of the short-term focus kind of users. And then for the real users, kind of like, well, the protocol's offering value and to get something on top that, maybe worth something in the future, that's great. But if not, they're not going to bank on it as a primary motivation for protocol usage.
That makes sense. Yeah, I was just going to ask how you guys are kind of thinking about future incentivization, but the lock drop idea is interesting. And just to kind of define that for listeners, it is some kind of an airdrop based on usage, but with vesting or penalties for sort of claiming tokens early. Is that a broadly correct definition?
Yeah, I don't think we would even allow claiming early. This is going to be a long vest. You are going to benefit if the protocol grows, but please don't use a protocol solely for this token.
Yeah, I mean, well, kudos to you guys for thinking about that. I think it's obviously much easier just to kind of give people free money to continue attracting TVL. So it's nice to see you doing the hard things now heading into the second season there.
See how it goes.
Yeah, exactly. Well, I guess kind of a little bit more forward looking here generally. My next question, I'm curious, what are the next set of overall innovations, improvements you plan to bring to term and maybe the lending mechanisms as well? And, what other things within fixed rate lending are you excited about going forward?
Yeah, so I think one thing we do want to focus in our next release of the protocol will be enabling some of that looping that we talked about. I think that would be possible on term. It require a little bit of tweaking in terms of how the auction mechanism works. It's a solvable problem, and hopefully that opens up the borrower base. Because right now the borrower base is still very concentrated to the very large whales. Whereas I think by opening up looping, you could reach a larger audience. So I think that will be a major focus for us. And beyond that, just really trying to continue polishing the user experience, the UI. I think the UI is very important. We're just focusing on getting more information, getting rid of unuseful information, trying to make everything just smoother and faster overall. I think that's super important.
Nice. Well, that's great to hear. And I guess as we're kind of coming up on time here, I am curious about just sort of when you started term, I guess, what was your sort of initial vision of success? And how much of that do you think that you sort of gotten to so far? And how have those goals changed over time for you, the team, and the protocol?
Yeah. If you look at TradFi markets, specifically collateralized lending markets in TradFi, about 60% is fixed rate and about 40% is variable rate. You come into DeFi and it's complete opposite. It's 99% floating rate and like 1% fixed rate. I think that over the long run, as the market matures, I think the TradFi market is a good proxy of what could be on chain. It could be actually fixed rates could be as large as, if not larger, than the variable rate markets, but it's going to take time. So I think that's the vision. I think that at some point we want to be at least as large as the variable rate counterparts in the space. But yeah, that's going to take a long time. So we got a lot of room to grow, a lot of work to do, and I think it's tough to build a two-sided market from scratch, especially now that DeFi summer has passed. It's a different atmosphere than it was early on. But just keep working. I believe we'll get there eventually.
I mean, to some extent, that's really all we can do. Just keep working. Well, Dion, thank you for all the time today. We will continue to, of course, support your products on vaults.fyi as well, and excited to add more stuff as you guys continue to launch things. But thanks for all the time. Where can people learn more about you, learn more about Term? Where would you like to send users to?
Yeah, you can check out our Twitter at term_labs or go to our website at term.finance.
Awesome. All right. Once again, thanks for listening. Talk soon.